Welcome to this update for the S&P 500, and I'm also going to be taking a look at the macro situation. Before I start, please remember that I do these videos just for fun as a hobby and always speak to a qualified financial advisor before making any investment decision. So I like to start at this long time scale where we can see that there's a clear trend of stocks going up over time. And we've mentioned before how ever since we embarked on new Keynesian economics, the gradient at which the level of the S&P 500 has gone up has increased more steeply. Pre the 2008 crisis, we had what was called the Taylor rule, where only interest rates were used. And here we still used to get these classic boom and bust cycles, but then it's become a lot more of a straight trend up since then, as well as a faster gradient with the introduction of quantitative easing as well. But then, of course, when we get to the Wuhan outbreak, we had this, what I call the FANG bubble, and then now even this AI bubble, which is probably more than anything just caused by the huge amount of money printing that was embarked on at this in this time. But when we zoom in, my base case is that we're on this all hell new Keynesian economics channel, and this is a yield of about 16% a year. Now, there is actually a steeper channel that you could draw here with a 41% yield, but for me, that's a incredulous number, and so I'm not really sure about that. I think it's likely it will stay within this channel, and that's my base case. I actually went 6% of my portfolio into the S&P back here in December, and this blue line here is what I was expecting to happen, but actually we've been blazing away all year. And my base case is that we may retrace back a good 15%, but by the end of the year, I'm expecting a strong performance, potentially following the elections in the US. And I hope to be able to buy some more a bit lower here. But really, by the end of the year, I'm hoping to have about 10% of my portfolio invested in the S&P 500, chasing this 16% per year yield. So this was my previous update, and actually, apart from me drawing this channel here now, not much has changed. At the end of the day, the US economy seems to be doing well, and as long as we stay in this trend, there's nothing to think about. It makes sense that the S&P 500 is doing so well because the US has a lot of hydrocarbon wealth, much more than most other countries. And when you look at the stocks that make up the S&P 500, they've got the best stock sectors in the world. So it makes sense to me why we're enjoying this trend. But like I say, there could be like a 15% retracement at some point whilst remaining in this trend. So onto the macro, and GDP growth is looking great at the moment at about 3% versus the 2% target. Unemployment numbers are very low at about 4% versus the less than 5% target that I've given it. And the stock markets and house prices are doing great. So really, overall, the US economy is doing great, justifying this trend. The fly in the ointment, of course, is inflation. Now, the Fed likes to report the year-on-year inflation as its target, but for me, that's not a very useful number. Even that number is too high at 3% when it's supposed to be 2%. But I think that actually what's more important is the month-on-month and particularly quarterly numbers, which have been very high this year. And this 0.2% number that was just reported is actually the target. So it's not even a low number. And I like to take the quarterly CPI numbers and find this much better data to give us some kind of nowcast. And by multiplying the current number by 2 and then adding the previous 2, that's how I've arrived at my kind of nowcast of 3.8% inflation. And actually, regardless of whether you use the year-on-year numbers, which is too high at 3%. My nowcast numbers, inflation's definitely too high as far as I'm concerned. So this is why I can't see them dropping interest rates. Here we have the longer term trend, and we see interest rates in black here, now up here, and I'm kind of suspecting that it will kind of stay up here, perhaps above 4% for longer than everyone's thinking. The red line is inflation. As you can see, we're in a nasty zone up here still, and in the long run, we want it to be more along this 2% line. And the green line, that's the GDP growth, which is actually in the sweet spot here, between 2 and 4%. The unemployment, of course, the trend there is looking amazing. And here we have the government debt and fiscal deficit as a percentage of GDP. And although these numbers are higher, it has a bit of a stable look about it. But as I'll get onto later, I think that the extent of the fiscal deficit, although it's kind of stable and isn't going to trip up the economy, it may actually contribute to the higher interest rates because it forces higher yields in the bond market on the long end. And I think that does influence the short end. So here I've got the control panel that the masters of the universe at the Fed like to use, in the guise of New Keynesian economics, to hit their targets of stable GDP growth and low unemployment. Now, this system, which has prevailed since around 2009, has only been possible in a way that it wasn't possible before then because of various deflationary forces at play, particularly the growth of the internet and globalization. And around the COVID period, we had some inflationary forces counteracting that, which led to our inflation problem. But these have mostly diminished now. One thing that has been concerning me was this problem with the Houthi rebels and the fact that now most of America and Europe can't use the Suez Canal anymore. However, it doesn't seem that this crisis has led to a supply chain issue as much as we thought, but it's certainly something to keep an eye on. Final linchpin that enables the economic policies of the West is the strength of the US dollar and the fact that it's a world reserve currency. And so, of course, I look at the Dixie as an indicator of that. And actually, the US dollar is looking quite good, frankly. I will point out, though, I have noticed a bit of a technical pattern. And here we see the Dixie. And yeah, to me, that's quite a clear technical pattern, and which actually resolves just as we come up to the US election, funnily enough. So this will definitely be something to keep an eye on. And then, of course, the yield curve. And this is what a yield curve is supposed to look like. That's the Japanese yield curve. And this is what the US yield curve looks like, inverted. So it's because we've got this unstable inverted yield curve that I've put a yellow line around the USD. We do have to remember that although everything's looking great, apart from a little bit of inflation, this inverted yield curve needs to be highlighted as a potential signal of future risk and instability. And it's nice to look at the data plots on this chart where we just see the interest rates have stayed the same this year. QE is, they've actually announced a reduction in its extent of the quantitative tightening, but there's the numbers. And inflation, like I say, is a bit on the high side if you exclude just this one data point, which still wasn't a low enough number for them to be dropping rates, I would have thought anyway. But apart from this inflation niggle, everything else is looking excellent. So I'm quite happy with my current base case, and there's really, as long as we stay in this trend, there's nothing to worry about. Do plan to top up my holdings of the S&P 500 to 10% of my portfolio, hopefully when we get a bit of a drawback later in this year. But if not, I can anyway, and I'll still have a decent average buying price. So that actually completes the executive summary for my macro and S&P 500 update. So some of you may want to switch off now, but for others that like a bit more detail, I'll now go into the rest of my data in more detail. So first of all, I have this presentation of the different macro factors. And actually, we can see that it's a little messy initially because we've got, according to the new Keynesian economics model, the stocks and the GDP go up when you lower rates and have more quantitative easing. But actually, it's perhaps a bit more nuanced than that because when everything's going good, you can have high interest rates like we did here. Um, they can increase them and they're kind of making hay while the sun shines, and then deploy the lower interest rates in case of emergency. QE is like another tool that they have, which again they can manipulate to the same effect. So currently, the economy actually being in rude health, they can keep these high interest rates banked. The QE they're obviously slowly reducing, but they've reduced the level at which they do that. But we kind of still do have crazy high amount of money that was pumped into the system compared with historically, and that perhaps explains these bubbles that we're experiencing. So overall, it's not really a perfect data set here in terms of trying to read into it certain patterns, but what we can say is that certainly while stocks are doing this, whilst the GDP is still increasing, I can't see a reason for them to drop the rates. They're perhaps only going to drop them in case of emergency. So here we have the fiscal deficit, and when we look at the 2019, this was kind of the model year before COVID. We see that we're now habitually spending more money, and here we have the fiscal deficit of the US as a percentage of GDP, and this was the number during the Second World War, and it's probably not at a comfortable level, but fairly stable, not actually that much more than it has been going all the way back from the to the 50s. Here's historical interest rates, which show that were they Fed to keep the rates where they are, that's actually the historical norm. There's good reason here that 0% interest rates were the abomination. And here we have inflation where we see that actually anything less than 6% was kind of normal for a long time. You could kind of say that the current setup actually more stable than back in the past, with the exception of what happened following the Wuhan outbreak. And here we have house prices looking great in the US. And here's the Fed GDP now data, which is what I use for the GDP forecast. And this is the long-term GDP in the US. It's very interesting, this exponential pattern here, which I think ties in nicely with the long-term trend in the S&P 500. And here we see how amazingly low unemployment is in the US. Here's the US government spending, and we see that actually in just the 9 months of this financial year so far, we've spent more than in the whole of 2019 fiscal budget. So yes, the government is being excessive with its spending, and whereas 8% of its fiscal budget was net interest back in 2019, that number's now risen to 13%. However, although I've seen a lot of people picking on the interest being paid as kind of proof of the end, to me, it kind of does look manageable at the moment, but presumably before too long that will need to get addressed. And here we see the tax receipts of the federal government against the what they're spending, and here you see that really there's a 27% shortfall there. And you know, that's these do look like alarming numbers. It's just that the US kind of gets away with it, having a world reserve currency and relative to the other currencies. So it's not like, for me, it's not alarm bells ringing yet. But I do think that the fiscal indiscipline will impact yield curves. It explains why yields are staying higher on the long end, in my opinion. And here we have 10-year Treasury yields, and exactly what I just said. They're trending higher on the longer end. And as an interesting, you can draw a trend line here that this long-term trend is reserved. One hand, now this it's interesting to see. There is something potentially happening here, and if that was to break to the downside, then that could actually signal that you know, all the people who are into investing in bonds are right. You know, and then maybe something nasty happens as well, and then we see them dropping rates at the short end, and somehow on the long end they drop. We've got not too much longer to wait before we see a proper trend emerge here. And here's the evolution of the yield curves. And really, it's the same story of they're still currently looking quite unstable. And here I've highlighted two possible scenarios that we could get back to a normal yield curve. One is if all of the bond traders, the people who are speculating on bonds at the moment, are right, we get this big recession and big disaster, and then that leads to deflation, really. And then that allows the Fed to drop interest rates like they have done in the past. Jumping back to here, we're looking at an event like this here, the credit crisis, or this here, the Wuhan outbreak. So, like in the past, bond investors are speculating that's going to happen again because of a big financial collapse. And then there you go, that drops the lower end of the yield curve, because obviously the base rates will influence the shorter end of the curve. And then the longer end can even just stay where it is, and we're back to a normal yield curve again. Now, another way we could get back to a normal yield curve, and this is my speculation, is that maybe we do get some reduction down to say 4% or something, but because inflation pops up, they can't really reduce rates anymore. And because of the kind of fiscal and discipline issues we have, that leads to actually increases in the long end, maybe up to 6% or something. So I'm keeping an eye on the yield curves, and obviously I'm looking for to track this happening in order for my base case, which is the all hail new Keynesian economics base case, to be true. Finally, this is the M2 trend, which again, just like the GDP trend, is a exponential trend. And this, to me, does explain and help support why stocks are able to go up at a 16% a year clip like they have been for many, many years, really. I think there's a relationship between that and the exponential increase in money supply of this new Keynesian economics behavior, which involves you know, running the economy at a deficit and with relatively low interest rates, and with lots of money printing to boot. So that would explain this kind of exponential pattern in money supply. And of course, eventually you'll get to a death phase because the steepness of this curve will become so insane that then, it's just kind of mathematically all going to end in tears. And I feel like the Fed and the government's trapped in this economic system now that it can't get out of. They just have to continue printing more money. And the thing is, though, when you actually zoom in to just say the last 10 years, we had this blip, obviously, because of the extraordinary amount of money printing after following the Wuhan outbreak. But I think we're now reverting back to the normal, the trend line. And I'm looking, if it doesn't, then I'm wrong and I have to reevaluate everything. But if I'm right, I'm looking for this to go back into a exponential trend, just the same as GDP has. But actually, when you zoom, although it looks scary there, when you zoom in, we go back to the exponential trend. It'll actually won't act. It's actually still not that bad an increase that we can say we're getting close to the death phase. And so we've probably got a good decade or so to go before the steepness of that slope becomes just so ridiculous that we really have to say we're approaching the death phase. So that completes my look at the S&P 500 and the US macro. I hope you found that useful and look forward to speaking to you at the next video. I do videos like this one just for fun as a hobby. It's for entertainment purposes only. Always consult a qualified financial advisor before making any investment decision.